Good morning, everyone. Welcome. Come on in. Welcome, Kevin. Welcome, Kyle. Good to see so many names. We'll give it a second so everyone can join in our Zoom room. Happy to have you all here. Hey, Ross. Hey, Matt. Glad that we're all dialing in here. We have had a couple internet outages in Montana, and they're statewide. So if we do drop at any point, we'll be right back as soon as possible. So we're just going to roll with that. Happy to have you here. Welcome. Hey, Vincent. Hey, Tammy and Susan. Wow, got a lot of folks on this morning.
All right, 36 attendees already.
Nice. It's the top of the hour, and it's the first Wednesday of the month. So we are here today with two of our teammates from the FAB Encounters team to talk about bookkeeping basics for financial advisors. This is a topic that I hear a lot of people like to outsource. So it seems that financial advisors don't necessarily want to be doing their own books, which is why we have Hayley and Dan. Each month we come together with a new topic and an expert to share advice and answer questions from future XY Planning Network members. Since we've been hosting these calls, we have been told they are incredibly helpful as people prepare to launch their own firms. Sometimes people even attend them for years before joining because it's such a great way to really get a sense of our community and start diving into your entrepreneurial journey. Next month, we have another one. We're going to be with the Senior Director of Member Success, Maddie Roach, who has been here from the very beginning. She'll be talking about how to launch, run, and grow a successful fee-only financial firm. Lessons learned from hundreds of advisors. So she's seen it all. Maddie's been here since day one. So be sure to grab that link to register for next month's webinar come November. For today, go ahead and drop your questions in the Q&A module in Zoom, and we'll try to get to them as many as we can. We'll also be dropping links in the chat, but don't worry about writing everything down. We'll send you an email tomorrow with a recording of today's webinar and any other resources that we share. So for today, the bookkeeping basics for financial advisors, I'm going to turn things over to the manager of FAB Encounters, Dan Keslin, and FAB Encounters Senior Accountant, Hayley Stewart.
Yeah, hello everyone, and thanks for joining in on today's call. We're excited to chat a little bit about what we know with bookkeeping and why you may want to outsource it, and some things if you are going to do it that you should really be thinking about when you are doing your bookkeeping, just like the basics of what you should be doing for your RIA, some considerations, tips and tricks, or things to avoid. So without further ado, again, as Isabel mentioned though, first, any questions that come up, feel free to drop them in the Q&A. We will do our best to have about 20 minutes, 15, 20 minutes at the end of this presentation to answer those questions for you. Some of you already submitted questions, so thanks for doing that, and we'll be sure to address those as well. So I'm Dan Keslin. I'm the manager of FAB Encounters. I come from a background in accounting and finance. That's what my degree was in at Montana State University. I did taxes for quite a few years, as well as entrepreneurial sort of outreaches, starting my own business while I was in college. Eventually sold that and ran into Hayley, who was one of my classmates at Montana State University. And we sort of talked about XYPN and how's a great company to work for. And I ended up applying and I've been there ever since. So I'll let Hayley introduce herself now as well.
Hi guys, yeah, my name's Hayley Stewart. I am the senior accountant here at FAB Encounters. I've been with the company for about 3 years, actually next month. And yeah, my background, just like Dan, I graduated with a degree in accounting from MSU or Montana State University, and went on to work at a public accounting firm for 5 years before joining the XYPN team.
All right, thanks, Hayley. All right, I'm gonna go ahead and share my screen and then start presenting these slides here. Is that looking good, Hayley? All right. Bookkeeping basics for financial advisors, the topic for today. All right. So what is bookkeeping? Bookkeeping, as you all may know or you may not know, is really a method to record all business transactions and translate that into usable reports. So anything that goes through a business account, and by that we mean checking account, credit card, savings accounts. All those transactions can be recorded within a bookkeeping software or Excel if you decide to do that, and translate that into usable reports. Most used reports we're looking at and talking about really are the balance sheet and profit and loss statement. So why do you need to maintain your books? First, the main reason is compliance. Pretty much every, I would say at least 99%, we've reviewed almost 50 of the state's regulatory requirements. Most of the state's regulations say in some words or another that you need to maintain accurate books and records. So what that means is you really need to be doing your bookkeeping. Not only do you need to be doing it for them, well, the main reason to be doing it for them is because at any point in time, they could decide that they need to ask you for a balance sheet. They need to make sure that you're meeting your minimum net worth requirement. They need to make sure that you're doing things on an accrual basis as they have dictated in their regulations. So they could ask you for statements, they could ask you for reports, they could ask to have it done within 6 days, 9 days, within a week. And as long as you have books, you'll be able to do that. The second main reason, maybe Hayley, you want to talk about this one, is tax purpose.
Yeah, most of you guys know you guys have a filing requirement for taxes each year, whether or not you're just a W-2 employee or you own your own business. You are required to file with the IRS, and 85% or 90% of the states also have that filing requirement. I know if you don't have an income tax requirement, but you do need to keep financial records in order to file your tax return, whether that's going to be a Schedule C for you guys that are a single member LLC, filing as a disregarded entity, or you're a corporation filing as an S Corp. And if you're an S Corp, you are required to have a balance sheet and be able to provide that at any given time if there was an audit.
Exactly. Thanks, Hayley. Yeah, and another reason to really have accurate books for doing your taxes is if you don't, when you go to your CPA and they say, what do you have for your business? How do you know how much money you made? Do you have a profit and loss? And you say, well, actually, I don't. You're going to save yourself a lot of money by doing the bookkeeping yourself rather than paying your CPA $200, $250, $300 an hour, basically recreate your books for you. So aside from that, you're going to have the taxes will be able to be filed more quickly. You'll have some time savings there. Having up-to-date books will allow for a quicker filing. Another thing as to why to have bookkeeping is you can analyze your business performance. If you use like a chart of accounts template and you keep your books up to date and you have accurate, consistent record keeping, you can look back over the prior years and sort of see what is your average gross profit margin been? What can you do to improve that gross profit margin? How much did you spend on marketing and lead generation services each month over the last 6 months? These are all details that you can dig into within QuickBooks as long as you have consistent, accurate records. The final one here, debt funding. Many of you probably own a home or have tried to get a mortgage or get a loan to start your businesses or buy out another business. When you go to the bank to apply for that, they will ask you for your balance sheet and your profit and loss statement year to date or prior years. And really having accurate, well-kept books allows you to have that at sort of the drop of a hat. It'll allow you to, as long as you have everything up to date, it'll allow you to easily pull necessary reports so you're not delaying the mortgage process. Implementing an accounting system. Hayley, do you want to talk about this one?
Sure.
Yeah.
Implementing an accounting system. I guess first off, I'll start with saying FABC, and we exclusively use QuickBooks Online. This is the system that we have found to be the most powerful and efficient. Reporting is great, and it connects to almost all bank accounts. I think there's only a handful that it doesn't connect to. So just as a heads up, that's what we use strictly, but there's other accounting systems out there such as QuickBooks Desktop, Xero, Wave, FreshBooks. We put Excel on here, but we don't recommend that. That gets to be a little tedious, making sure everything flows through correctly. It's a big time suck, and 9 times out of 10, you have a formula that's miscalculated, and miscalculating, and it's not going to throw through properly. Another thing why we don't recommend Excel is under audit, occasionally they will ask for a reconciliation report, and that is something you cannot provide when using this software or this subscription. But from what we can tell, most people have had success using Xero and Wave as well. So just so you know, QuickBooks Online isn't the only one out there. but that's the one we use because we know it the best.
Sorry, my screen stopped sharing. Here we go. Coming back to here. Here we go.
Awesome. Yep. And just so you know too, it does say down there, but XYPN members can get a discounted QuickBooks online subscription rate, but just know that's for subscriptions that are just starting. So if you have one already, unfortunately, we're not able to offer that discount to you.
All right, next thing here, setting up your books correctly. Quick tip before we start, use our chart of accounts template. This is on our website. It's a freebie. Just go ahead and download it and start using it. You can import that into your QuickBooks file, and it really just allows you to have that chart of account template that we've developed over time. It translates easily into tax returns, and it also allows you to compare yourself amongst others within your industry as long as you're using the same categorization techniques. Setting up your books correctly. Link your bank and credit card accounts. This is really important because any transaction that comes through those checking or credit card accounts for your business will be able to come through QuickBooks as long as it's linked. Like we said, we have found very few banks that do not connect with QuickBooks. We can't speak to Xero or Wave or FreshBooks or any of the others, but most banks do connect with QuickBooks. So that means it pulls in transactions into a banking feed and it's all right there for you to just go in and categorize it. Important note, only business accounts are connected. If it is a personal account tied to you, like say you have to, you can't get a business credit card because you don't have credit history with your business. If you have a personal account that is exclusively used for business, then that one would be okay to connect until you can get that business credit card account connected. Basically, anything that's tied to your EIN or your employer identification number, tax identification number, to that business should be connected to QuickBooks Bank Feed. If it's not tied to that, it probably should not be connected because we don't want personal transactions going through the business. Opening balances. So this is where if you had an existing business and you're starting a new QuickBooks account and you haven't had QuickBooks going the whole time, you want to make sure that your opening balances are correct. So basically you're going to pick a time period. We try to encourage everyone to tie out to the end of the year. So using your prior year tax return, whatever was filed with the IRS or with your state, take those balances, do a journal entry in the books to get those opening balances correct, and then move forward from there. Yeah, like I said, if you're an existing entity, you're going to tie it to your prior tax return. All right, adding business expenses paid through non-business accounts. This is again when you're sort of starting with those opening balances, starting your business out, and you don't have, you were paying for your XYPN dues, for example, before you had your business account set up with your bank or your LLC set up or your RIA registered. You may have paid some dues out of a personal account. That's totally okay. That's understandable. That happens as part of running your business. The way to do that is you can use a journal entry to get those expenses on the books so that you can deduct those because those are business related expenses. Talk to us. We're happy to show you how to do that. That's a little bit more advanced technique, but that's again, something that should be done when setting up your books so it's done correctly. All right, now we're gonna move over to Basic Accounting 101. This has been a while since Hayley and I were in this class. So we had a little bit of time trying to figure out exactly what to say here. But the basics of Accounting 101, we have assets, liabilities, equity, income, and expenses. Those are all the detailed types of accounts that you can have within QuickBooks Online. So assets, what are those? Really your bank account, checking account, cash on hand that you have for the business, accounts receivable, then any like furniture, building assets that you may have bought for the business. Those are all asset type accounts. Liabilities are going to be your credit card, any loans you have, any payroll liabilities. If you do happen to have employees, those are all liability accounts. Equity, that's really where you have put money into the business. Say you contributed $100,000 to your business to start it up. That would be increasing your equity. Whereas if you are in a business that's been in operation for a while and you're generating revenue, you're taking money out as a distribution, that also decreases the equity that you have in the business. Income, that sounds, you all probably know what that one is. Income is any deposits that go into the business that are directly from clients that should be recorded as gross income. So that will be reported on your taxes. It's not deposits from you, just to be clear. This is deposits from clients for services that you render to them. Expenses, these are typically in your industry recurring type expenses, like you're paying every month XYPN dues, you're paying every month for FAB encounters to do your bookkeeping, you're paying for your software subscriptions. These are also a type of account that will show up on the profit and loss side of the business. So the overall equation for the balance sheet is assets equals liabilities and equity. If you are using an accounting system such as QuickBooks, Wave, Xero, they will, as long as you're not using the self-employed version of QuickBooks, don't use that one. We forgot to mention that previously. Your assets should equal the liabilities plus your equity. So any money you put into the business, any credit card balances should equal the total amount of assets that you have in the business. The software will calculate that for you and make it accurate. Now we're going to talk a little bit about debits and credits. Really the debits, you might have seen it in accounting classes if you were in business school, have a little plus next to them where credits have a minus. That's because debits are increasing asset accounts. When you debit your asset account, say you debit your checking account, that's going to be depositing funds into that account. So debits increase expenses and assets. Debits decrease income, liability, and equity accounts. Credits are basically the vice versa. Debits have to equal credits in every transaction. Otherwise, QuickBooks won't let you record it. But credits decrease expenses, increase income, decrease assets, and increase liability and equity accounts. So say you deposit, let's say the 100 grand into the business checking account from your personal account. That's going to increase that asset account. So you're going to debit that asset account, and then decrease or increase that liability account. So you're going to credit the liability account. A lot to think about there. Accounting 101. Sorry if we got a little bit too detailed in it there. All right, fundamentals here. So now we're going to talk a little bit about the fundamentals of like how to do your bookkeeping, what it means to do your bookkeeping, and sort of some things to think about there. Hayley, you want to take this first one here?
Absolutely. So once you have your QuickBooks file or whatever accounting software you're using set up and going, the first thing you're going to want to go ahead and do is you're going to want to categorize the transactions from the bank feed. And basically what that's going to do is you're going to have the ability to add expenses and income into the bank account. So QuickBooks is going to pull them all down for you automatically, but you still have to go in and you're going to have to decide what expense account is it going to hit to? Do you have multiple income accounts? You're able to then go through and categorize accordingly. For picking the kind of the best category, just do your best. It's whatever makes the most sense to you. We've, looks like Audrey dropped in the chart of accounts to the chat. We have a pre-filled one set up, but if you decide that something makes a little bit more sense, feel free to go ahead and change those to best suit you and your company. It's not a make it or break it thing. If it is an expense, go through the chart of accounts. And like I said, pick the one that's most fitting. So for example, Right Capital, you'd probably want to put it to something like software and technology or dues and subscriptions, something along those lines. It's usually the same amount each month, and it could probably go to the same chart of account or expense account. Same thing with, for instance, XYPN dues. It could go dues and subscriptions. We have things like membership fees. So don't get too caught up in that. Just make sure that they're going to an expense account and it's hitting your profit and loss statement if it's an expense and or income. The next thing, after you've manually or you've categorized all of the transactions in the bank feed, you'll want to manually enter any non-connected accounts. So some of those non-connected accounts typically tend to be brokerage accounts. So you may have to go in and enter any deposits you received into a TD Ameritrade account or a Charles Schwab account, anything like that. That's when you would go in and manually enter those to get them onto the profit and loss statement and to update your balance sheet. After you've gone through and categorized all of the transactions, you've manually entered everything that needs to be entered, your next step is going to be reconciling the accounts. I usually hear, like, why do I need to reconcile? It's all coming through automatically. QuickBooks and most accounting softwares are great. However, it occasionally glitches. And so you're checking to make sure what's actually hitting your QuickBooks or your accounting software is actually also hitting your bank account and vice versa. Sometimes I've seen it where it's doubled up transactions. It hasn't brought in transactions. I had a weird one time where it brought in all of my income as expenses. So it's just a good double check. You're going to want to get in the habit of reconciling and just making sure that what you're showing on the balance sheet actually matches what's showing on your bank statement and or credit card statement. And I guess how to navigate, this is specifically for QuickBooks Online, but to navigate to the reconcile screen, you're just going to want to go ahead and go to the register and then click on the green button that says reconcile in the top right hand corner of the screen. There it will ask you for the ending balance of the bank statement and also the ending statement date. So you'll go ahead and enter that information. You'll press reconcile. If everything's gone in correctly, what will happen is you will be showing a $0 difference, I believe, in the left-hand corner of your, right-hand corner of your screen. If that number is not at 0, it means that something is missing or something has been doubled up, and you're going to want to go ahead and go through that reconciliation and check things off one by one.
Thanks, Hayley. Yeah, the reconciliation is very important, as Hayley mentioned, just to really ensure that there's no missing transactions, there's no duplicate transactions, and really what's showing up on the bank statement matches your bank register, matches your balance sheet, everything's matching and reconciled. Next step here, after we do the reconciliation, adding transactions, we're gonna review the profit and loss first. Really, that's to ensure consistency. So what I mean by consistency is ensuring that every transaction that you've entered over the past year to the same vendor is categorized to the same account. That's really gonna allow you to analyze your books better. We talked about that in one of the first slides, like why do you do bookkeeping? For business performance analysis. If you have it categorized consistently, you can sort of see month over month how much was spent on tech, how much was spent on marketing, as long as these transactions are categorized to the same account each time. The other thing you're gonna wanna do when reviewing the P&L is reviewing uncategorized income and expense accounts. Typically, when you're doing your own bookkeeping, you probably won't be putting transactions to here. You might be using the Ask My Accountant one more often. But when we're doing bookkeeping for you, we put things to uncategorized expense and income accounts. Those really, just like it sounds, we don't really know what category to put them in. So we're putting them there as a holding account to ask you where they should go. So review those accounts, make sure that those aren't left in there for any long period of time because it's not accurate. If you send that P&L into your regulator or to your tax account, they'll ask you what they are anyway, so you might as well stay on top of it and get it done. The other thing to check when reviewing your profit and loss is make sure that every transaction has a vendor. We say this is probably our #1 statement that we say all the time. Every transaction needs to have a vendor. There are reasons why this needs to be done, but QuickBooks also in the month-end review that we'll be talking about in a little bit points this out to you so that you can easily see it, you know which transactions need a vendor. Most often, this is when you miss it in adding in the bank feed, or if it's a check and you don't remember who it was paid to, but you remember what the amount was for, you'll just add that transaction without a vendor. Go back in, add a vendor. It's needed for 1099 purposes that we'll be talking about a little bit here. Final step, review your balance sheet. Here's the two reports that we typically look at, the profit and loss detail maybe, and then the balance sheet. You're really gonna be ensuring that the bank and credit card balance matches to the statements. Reconciliation does one thing. It really ensures that there's no missing transactions, no duplicate transactions. But what if you wrote a check 3 months ago and it still hasn't been cashed by who you sent it to? That bank balance is gonna be showing up as less on your balance sheet than you would have reconciled to, because that check is directly crediting your asset account balance. That's totally okay if the balance is showing up indifferent, but you just want to make sure you understand why that difference is. That could show you some other issues that happened during the initial setup of your books. If the opening balance equity was off, any of those accounts could be affecting those balances. Just figure out why. Another thing is looking into any negative balances. You typically don't have negative balances on your balance sheet. There are certain instances where you will, that we wouldn't really get into right now. But if you have a negative balance in an asset account, say your checking account or your TD Ameritrade Sundry account, that typically means that something's off on the reconciliation, something is missing there. Same thing with credit card balances. You can have a negative balance there if you overpaid it, but if it is a consistently negative balance, there's probably something going on there where there's a missed transaction, overpayment, double payment, things like that. Go back and do your reconciliations. Another account to make sure you review is the uncategorized asset account. That's another one where if you are doing your own books, you probably wouldn't put anything to there, but we would use that one. Say if you bought some furniture and we wanted to ask your CPA if they wanted to depreciate that or capitalize it right away, we'd put it to uncategorized asset account to ask you about it. If you have something that you buy for your business and you don't really know how it should be handled on a categorization basis, whether it's an expense or an asset, or if it's a piece of furniture, go ahead and put it there. Ask us about it. It's better to put it somewhere that you'll remember to ask about than to put it to a random place and forget about it until your CPA needs to find out about it later. The other thing is to verify liability accounts are zeroing out. This mainly pertains to payroll. If you are withholding payroll taxes from your employee or yourself, if you're an S Corp, and your business is holding those funds, you want to make sure it's zeroing out. What zeroing out means is that when that liability is paid to the IRS or paid to your state, that balance is zeroing out. So make sure that there's no balances left in those liability accounts. If there are, it may mean you missed a payment. That's something you'll get notice from the IRS if you do that, or the payment amount is incorrect. Other considerations, meals and entertainment. Was I going to talk about this one, Hayley, or is that you?
That was me.
Good, go for it.
All right, meals and entertainment. When setting up your chart of accounts, you're probably going to want to make sure, when we said don't think too much into it, make sure you have meals separate and entertainment separate. The reason why is because for tax purposes, entertainment, for if you take a client out golfing or you go to an NBA game or something like that, that's no longer tax deductible. And so it needs to be recorded in its own separate account. So when your CPA goes and does the tax return, they can make the necessary adjustments to make sure everything is accurately recorded there. I would say as far as entertainment goes, if you go and go to an NBA game and while you're there, you get a meal or some food, that still is 50% deductible as long as it's on 2 separate receipts. So just make sure you've got your entertainment receipt on one and your meals on another one. So same thing with golf, just make sure those are separated. If they're on one, it appears that you will lose all deductibility when preparing that tax return. So you'll usually want to have, I guess, 3 accounts. You're going to want, if you have employees, you are able to, if you have an employee event or an employee party, that's 100% tax deductible. So you'll want to keep that separate from just business meals, whether that's travel meals, taking a client out to dinner, or maybe you're going and doing some business development with a marketing firm. Those are all tax deductible at 50%. So you're just going to want to keep those 3 items separate from any other category. So just something to think about, just make sure you have those things separated. If you have questions, I'd reach out to a CPA and just make sure they're in agreement with that. Next up, I believe, is grossing up payroll. Okay, grossing up payroll. So if you guys have payroll and you're using a software, probably other than QuickBooks Online, what you'll need to do is that if it doesn't integrate, things are going to be coming into your bank account at net. And so you'll have to go in and gross everything up, which basically means you are increasing the salary to show what the true wages paid were before any withholdings. And then you're going to want to take out, or you'll have the employee and the employer taxes withheld and any other deductions or possibly reimbursements. You will need to go in and split those items out because what you'll see with most softwares is they're just going to randomly take out $6,000 out of your account and you don't know what it's all for. So grossing up payroll just essentially means you're putting everything back in to match what you truly paid.
Exactly. Yeah, the other consideration with grossing up is the income side of things. Many of you probably will end up using advice pay if you're doing the monthly recurring retainer model. Advice pay, when you bill someone, say $200, you transfer those funds to yourself and it shows up as $198 in your account. That is because advice pay takes their fee off the top and sends you the net amount of that income. You want to make sure that you're grossing up that income to actually show that you received $200 of income. Then you have a $2 bank charge or merchant account fee expense. And the main reason for doing that is if in the event that you receive a 1099 or the IRS receives a 1099 from advice pay for the income that you have earned, you want to make sure that what you're showing on your profit and loss statement ties out to what is reported to the IRS. Just a matching issue could come up if it's not, so make sure you gross those up appropriately. Next one here, adding to the chart of accounts, what's appropriate and what's not. Really, we don't want too much detail in the chart of accounts. And this is because you add a vendor name for a reason. You don't want to have software and technology and then have Right Capital, Bridge, XYPN as account names. And because you can find that out by running a different report in QuickBooks, we're trying to keep the profit and loss generic enough to be comparable and translatable to a tax return. And if you have so many different accounts in there, you're using like 100, 200 accounts, your CPA is going to have a hard time figuring out how to translate all of that into the tax return, and then making sure that everything ties out, ensuring that they did deduct every one of those expenses, did count all of that income. So keeping the chart of accounts sort of simple is a best practice that we found over time. Of course, you can add sub accounts, like if you have legal and professional fees and you want to keep track of how much you paid for accounting versus attorney fees, that's totally doable. That's totally fine to do. It's really what we're talking about is naming accounts by the vendor, not a best practice. Loans, principal versus interest. When you are making loan payments, if your business owns a house owns a commercial building or has a loan to buy out another book of business, that loan payment that you make is the total amount of principal and interest. As you probably know, only the interest is deductible to your business and the principal is reducing that principal balance on the liability. So that is where you will split a transaction to ensure that you're putting the interest to the profit and loss and the principal portion to the balance sheet. You should probably be reconciling that balance sheet account as well. Just have an amortization table reconciled to the ending balance for that period, making sure the principal amount is correct on the balance sheet.
All right, 1099s. This is always a hot topic, usually come year end when your CPA or your bookkeeper or accountant says, hey, have you sent out 1099s? What are these? These are forms that are sent to the IRS basically to say, I paid this company for some type of service. You are required as a business to send, or you possibly are required to send a 1099 to any business you paid for services and or rents in more than $600 throughout the course of the year through a bank account, Zelle, Venmo, ACH. If you pay them with a credit card or through PayPal, you do not have that filing requirement. So one tip we always say is if they accept credit card, pay them with a credit card because you won't have to think about 1099s and figuring out, who do I get a W-9 from? Do I have this requirement? So essentially what you're going to do is if you pay somebody through a bank account for services provided, whether that's going to be marketing, business consulting, legal fees, you're going to want to send them a copy of a W-9 and have them fill this out. Depending on how they fill it out will then depend on if you send that a 1099 at your end. If they are taxed as a corporation, that negates your requirement to send a 1099. Unless they're an attorney for legal fees. You always have that requirement if you've paid for legal services. So one thing I always say, just get in the habit of doing is always collect a W-9 up front. You're more likely to get it at the beginning than if you're asking in January when they're probably being bombarded by a lot of clients or vendors. So yeah, 1099s, there's actually going to be a change for 2020. You now have two separate forms. There's a 1099 miscellaneous form, which this is going to be used for rent. And that's probably really going to be the only thing you're going to file on a 1099 miscellaneous. The new form for this year is a 1099 NEC, which is non-employee compensation. So you may have several different 1099 forms that you're going to be sending out for 2020. The other thing to think about is if you have any loans on the books and you are paying more than $10 in interest, usually to an individual. So you had a family member that loaned you some startup money, you paid them more than $10 in interest, you will have a filing requirement on a 1099 INT come year end. So those ones are due to the IRS, I believe by January 31st, they have to be sent out to the vendor by February 28th. I don't know why there's a difference in those two, but if you're sending them back to the IRS by the 31st, you probably should have sent it to the vendor by the February 28th. So.
Thanks, Hayley. Yeah, and everyone, if you subscribe to our blog, we'll be sending out another blog at the year end about 1099s, maybe a flow chart in there. It's still to be determined, but we'll sneak peek about maybe a little bit more detail about how to get those 1099s done, what that process looks like, sort of a flow chart to walk through to see if you have that 1099 filing requirement or not. Next one up here is cash versus accrual. I'm not going to get too much into the weeds on this one because it is a pretty advanced topic, I think. Accrual accounting isn't easy. in many states require financials prepared in accordance with GAAP is what the state regulator says, including at SEC level. What that means is you need to recognize income when it's earned, not when it's received. You recognize expenses when they're used, not necessarily when it's paid. So that's the difference between cash and accrual there. We have become experts on doing this for many states that do require accrual accounting. Our compliance department is on first name basis with many of those regulators. So we work closely with the compliance department to really understand what that accrual requirement is on each state's basis. Finally, receipt management. This is, in the event of an IRS audit, you would probably need to substantiate your expenses, substantiate your deductions, show receipts. Really what we're saying here is do something. Take a photo, like store it on your phone, have a Google Drive set up, have Dropbox set up, upload those photos to that place and name it. Really, it's just making sure you have a system in place so that you are capturing those receipts is our best practice there. Using your phone, having an app is probably the best way to do it. All right, moving over to tips and tricks. Banking rules. So we just wrote a blog about this. Go ahead and read it. I'm sure someone will drop it into the chat for you or maybe include in the follow-up link. But banking rules basically are a powerful tool within QuickBooks that you can set up a rule to auto-categorize transactions. Say you know you're going to be paying XYPN $434 a month for the next year. You can set up a rule that will look at that criteria. It'll say XY Plan Network, that's one of the criteria. And the amount is $434. You can say, name the vendor XYPN, and auto-categorize it to dues and subscriptions or membership dues or association dues, and auto-categorize it so you don't even see it. That will save you some time. I guarantee it'll take you time up front to get it done correctly and get it figured out. But in the long run, if you don't even have to think about or look at those transactions, it's like automatically doing everything. It'll be up to date to the minute. Second thing here is splitting transactions. Basically, why would you want to do this? So say you pay a utility company, for example, you pay them for your cable and internet and phone, but you want to track how much you're spending on your phone because a portion of it is your personal. You can split those transactions when they come in by hitting a little button on that banking page called split. You can assign a different category from the chart of accounts to each portion of that transaction. Reminder, QuickBooks will only let you add it if it totals the total amount of that transaction. So you have to do your math correctly, split those up accordingly. Month-end review function. This is something new in QuickBooks that we've started using because they just released it about a month or two ago. But this really is a pretty powerful tool if you're doing your own bookkeeping. It basically walks you through a review of your books on a monthly basis. So you say September 2020. Are there any transactions that are missing? Has every account been reconciled? When was the last date of the reconciliation? Are there transactions that haven't been reconciled? And then it will also remind you to review certain things like review your balance sheet, review profit and loss, make sure there's no transactions with missing pays, and then review any loan accounts to make sure those are reconciled as well. It's a pretty powerful function. We like it. Be sure to check it out. It's like on the top left of that tab on the left side of QuickBooks Online now. Very easy to access. We think it's pretty useful. Developing regular bookkeeping habits. This is a tip just because we don't want you to get to a point in time where it's the end of the year, you're trying to figure out how much you should have paid in estimated taxes and you haven't done your books yet. If you get in a good habit early of doing your books, set up those rules, make it like a monthly task that you do on the 10th of the month. As soon as you have your statements, spend an hour each month or 2 hours, however long it takes, you'll be better off in the long run rather than trying to get it all done hastily at the end of the year for your CPA. Another quick tip in QuickBooks, duplicating tabs. On the online version, you may have noticed if you've used it, it only opens one page for you. You can duplicate those tabs by right-clicking or double tapping on a Mac with your 2 fingers on the touchpad and click duplicate. This will allow you to have multiple windows open within that one QuickBooks file. And why would you want to do this? If you're in the banking feed, categorizing transactions, you see a vendor that you know you've categorized before, but you can't remember what account you put it to last time, duplicate that page, go to the expenses and vendors section, and look up how you did it last time. And you can navigate back to that other page and categorize it appropriately. There's another quick tip, Command on a Mac or Control plus click on a PC will open another tab. So you don't have to do the right click duplicate. You can just Command click and it'll open another tab for you. Mapping your products and services to the appropriate income account. So when you create an invoice in QuickBooks, you bill for a product and service that you have to sort of make ahead of time when you're setting up your books. say financial planning service fee, financial planning monthly fee, $200 is the product and service. You want to map that in your sales section of your QuickBooks file to the appropriate income account. So if you're going to track your income all in one, like just have generic income, then you don't necessarily need to do that. Just map it to the income account. But if you want to have sub accounts to really see how much you're generating on asset management basis, on consulting basis, on monthly planning fees, map those service items to those appropriate income accounts. So QuickBooks will automatically put that income there when you create that invoice. Recurring transactions, this is something in QuickBooks Online Essentials only, but this is pretty powerful if you do want to have invoices or sales receipts, anything set up to be recurring on a monthly basis for your clients in QuickBooks, whether it's just record keeping or you're sending them that invoice out of QuickBooks. You can set up those recurring transactions to automatically happen. It'll automatically send it on the first of the month. You can set it to only do it 12 times. You can have it set up on the 5th. You can have it due on receipt, due 30 days later. It's pretty powerful, saves you a lot of time if you just set it up that one time. The exclude function is something in the banking feed that you probably won't use very often. We don't want you to use it to exclude transactions that you pick. Say you went and took your kid out to lunch and you put it on the wrong card. You do not want to exclude that transaction, mainly because it's going to throw off the bank balance, throw off the transaction balance. Instead of excluding it, put it to owner's draw. That's totally fine to do. Just don't do it too often. But the exclude function, if you're, like Hayley mentioned, there's glitches sometimes in the banking connections. QuickBooks could pull in a duplicate transaction, or it may have missed one month and duplicated it next time. You will want to exclude that one because that's what will be throwing off that bank balance. Accountant settings, I think this is going to be you, Hayley.
Yeah, so accountant settings, this is something you guys can find from the gear icon in the upper right-hand corner of the screen. From here, if you ever need to change anything about your company, so you guys moved offices, you need to update a phone number, company email address, anything like that, you can do it directly from this accountant settings screen under the company tab. So just make sure if things do change, remember to go in there, update any of that information. EINs are always great. That's something we're usually going to request if you're having us help out with 1099s at year end. This is the first place we're going to check. So just make sure that information is updated and in there. The other thing that you're able to do from the accountant settings screen is if you have a requirement to send financials on an accrual basis, you're able to change the default within QuickBooks to automatically always pull financials on accrual basis right away instead of having to toggle back and forth from the report screen. And to do that, you would just go to the advanced tab under accountant settings, and under accounting, you would just switch the accounting method from cash to accrual. You'll want to Dan will talk about why it's helpful next to just have that on accrual in case you ever need to send reports to an auditor.
All right, things to avoid here. Mixing personal and business. Do your best to, if you're going out to lunch with your family and it's not business related, you're not talking about business, put it on a personal card. I mean, we see people all the time tell us that they talked with their business about their wife, therefore it's a business expense. Sure, we're not going to be telling you can't do that. We're not CPAs. We're not preparing or signing your tax return. But your CPA will want to see and you see that you have substantiated that expense. Be honest. Don't be overly aggressive with your taxes. It's not worth it. Put personal things on personal accounts. Having too many bank accounts, many of you probably have heard about the profit first mentality, where you have your income account, you have your operating expenditures account, you have your paying yourself account, you have your tax account, and then there's another account. I think there's like 5 or 6 checking accounts. This is good practice in theory, but it makes bookkeeping difficult. All the transfers going back and forth, having 5 different accounts to reconcile, it really just takes a lot more time for you to do that and make sure everything is accurate, make sure everything's reconciled, make sure the transfers are being recorded and matched correctly. So you can do that, but try to keep it limited. So it's not, having 10 accounts to reconcile on a monthly basis is a lot of work, a lot of things to keep track of. Best practice to try and keep it minimal if you're doing it on your own. Adding transactions with no vendor or payee. That's another thing to avoid. This is what we say all the time. Always have a vendor or payee listed on that transaction. As Hayley talked about with 1099s, if you don't have a vendor showing up on a transaction and they required a 1099, it won't show up when reviewing your books to see if they have a 1099 filing requirement. Just make sure you're getting the good habit on the first place of adding a vendor to every transaction. Another thing to avoid, changing the transaction amount after a reconciliation. If you reconciled a transaction and the amount is $5 and you change it to $10 because that's what it should have been or something's wrong, then you're basically changing that reconciliation. You're going to throw the reconciliation off by $5. You're going to throw the balance of your bank account off by $5. So you can change transactions, but just don't change the amount. You can change the vendor that you're paying it to. You can change the account that it goes to. Don't change the date or the amount. Deleting accidental transactions. This is where I was talking about excluding. Like if you put a personal transaction on a business account, for example, accidentally, don't delete it. Just put it to your owner's pay and personal expenses or member draw, owner draw, equity account. So it's just reducing your equity in the business rather than deleting it out, because that will throw off reconciliation. You won't be able to reconcile if you delete that transaction. The other thing that Hayley was referring to in the last slide was sending cash-based financials to your state that requires accrual basis. They will guaranteed reach out to you and say, hey, you're in accrual state. Why aren't these prepared on an accrual format? So know what your state requires. Talk to your compliance department, whether that's XYPN's compliance department or an outsourced compliance professional. Even call your regulator and ask them, what do they need to see? Make sure your books are matching what they say they need to see. Make sure everything is accurate moving forward. Set up on an accrual basis if they require that. All right, last thing here, why outsource? This is really why we're here. Like, why is FA Bean Counters a thing? You get your time back. You know, bookkeeping in and of itself, if things go well, isn't a hugely time-consuming thing. It could take you an hour, it could take you 2 hours. If you have something that comes up where there's a mistake, duplicate transaction, missing transactions, things don't reconcile, I guarantee this can take you hours. I mean, it'll take a long time to figure some of these things out. So really, that's where we're getting time savings there. We know what we're doing. We've been doing this for a long time. We can make sure everything's accurate and we can fix those mistakes relatively quickly. You also have the ability to reach out to us if you see things to get help on figuring those out. The value, I mean, what is your time worth? Are you charging $200 an hour, $300 an hour for your time, for your planning fees? Is it worth paying $75 an hour to get that bookkeeping done? I think it's a pretty simple equation there, but just something to think about there. Maybe when you have the time, it's worth doing your bookkeeping. When you don't have the time, that's really where your time value is something to consider. Peace of mind, I mean, this sort of ties into accuracy. We are going to be doing it on a monthly basis. We're not going to drop the ball and forget to do your books. You'll know that when you go into your books to review them, that things are reconciled, things are accurate. If they aren't, we will have reached out to you to get help to figure out why. So peace of mind, just knowing things are done. You can log into your books at any time and know that they're up to date. Accuracy, because we are bookkeeping and accounting professionals and we just focus on this industry, we are doing things accurately. We know what the regulators want. We're making sure that things are accrued appropriately and things are done correctly. Finally, you have access to a bookkeeper and a team who knows your industry. By working with anyone at FA Bean Counters, you really get access to work with that bookkeeper, reach out to them with any questions. If they can't figure it out, they can always reach out to our tax department, to our compliance department. You have a lot of resources there that you can leverage just by working with FA Bean Counters. So I think that about wraps it up, and we can move on to the Q&A here.
Great. We've had a number of questions roll in, so we'll try to get to as many as possible. Starting off, we have a question from Matthew. As a single member LLC who currently uses QuickBooks Self-Employed, is it necessary to switch to QuickBooks Online?
Short answer is yes, because with QuickBooks Self-Employed, you can't pull balance sheets. It's not a true double entry accounting system. You can pull a profit and loss. So if your state doesn't, I mean, there's a few states that maybe don't require balance sheets. I can't name them off the top of my head. Maybe Colorado doing your initial registration, but they can request a balance sheet at any point in time. So you're really doing yourself a bit of a disservice by not having it in a system that can do it. Double entry accounting, have that balance sheet off the bat.
All right, thanks. This is from Thomas. As far as business credit cards, do you recommend any, and do you have to a D&B? Hoping you guys know what that means.
Not sure what D&B means. Hayley, do you know?
I'm not sure on that one either.
Okay.
Thomas, go ahead and follow up on that question if we're, so we can just get some clarity. But Dan or Hayley, do you have any recommendations for business credit cards?
Yeah, you know, we've seen everyone use anything from a local credit union to the big banks like Chase, Amex, Capital One, all connect very well with QuickBooks. They all pull transactions in easily. You can have employee cards. There's benefits for like travel and whatnot. So we recommend going with one of those bigger ones. They've been pretty flawless for everyone we work with.
Okay. And Thomas clarified Dun and Bradstreet number.
I have heard that, but I'm not really sure. Thomas, can we follow up with you on that one? Cool.
All right. Okay, from Brad, we've got what are the best practices regarding business credit cards and how to capture electronically paying them from a bank account? So kind of a follow-up to Thomas's question.
Hayley, you want this or me?
Yeah, I can handle that one. As far as how you would capture the payment within QuickBooks, if you're paying it directly out of the business checking account, which is hopefully linked to QuickBooks, what will happen is essentially there's going to be a transfer from your business checking account over to your credit card account. And then when you're accepting those transactions. So once you make that transfer, whether or not you go from your credit card to your bank account or bank account to your credit card, the other one when you're going through and accepting transactions will say match, and you're just going to want to match it. If you are paying the business credit card through a personal account, what will happen is when it comes through on the banking screen, you can just go ahead and do that as an owner's investment into the company. So instead of having it to be a transfer, it would essentially just be owner's investment. If you want to get paid back by the company, you can always put that on as a due from to yourself on the balance sheet. The one thing with this is though, it may throw you guys out of your minimum net worth requirement if you are in a minimum net worth requirement state. So just be careful of those loans to shareholders or loans to single member LLC, the owners, if you are in a minimum net worth requirement state.
Are there some tax deductions that advisors frequently forget to track?
Mileage expense, I see that one frequently. Make sure you have a mileage log though. So you're gonna take that.
Home office is another one, especially right now. This will really be coming up a lot this year where everyone's working from home. You're probably not going into your office with a shared space. You can deduct, there's a couple ways to deduct this for home office. You have a simplified method. That's really just taking $5 per square foot of home office use. And the home office, again, needs to be exclusively and absolutely used for business purpose. It can't be like your kid's bedroom that you have a desk in. It has to be a home office. The other way is to take actual expenses. So that would be looking at the ratio of your office square footage to your whole home square footage. You can take, say it's 1/10 of the square footage, you can take 1/10 of the utility expense. You can take 1/10 of the gas and heat bill. So things to consider, make sure you don't miss those. Those are really closely related to taxes. So make sure to talk to your CPA about those more so than your bookkeeper.
How do you account for a PPP loan and proceeds?
Yeah, so the PPP loan is a liability to your company until it is forgiven. So what you'll do is when you receive that deposit or see that money hit your bank account, you're going to create a note payable within your accounting software. And it'll be a long-term note payable just because we're not sure if and when it will be forgiven and for how much. And then once the loan is forgiven and you know the amount, what you'll do is you'll go ahead and do an adjusting journal entry. If you need help doing this, you can contact us, but to move however much of the loan is forgiven off of the balance sheet and onto the profit and loss statement. And we recommend creating another income account, which that'll show up at the bottom of your profit and loss statement and just say PPP funding loan forgiven, something along those lines to easily denote it for your CPA when they're going and preparing the tax return is the best bet.
All right, we had another question about expenses since we are all work from home. Can I deduct my employee's home office space?
That's a
good one.
I haven't heard that. I would say check with your CPA. One way you could possibly, and like I said, maybe you reimburse them and it's considered rent. I'm not sure. That's my only thought around that.
I would guess if you're not having any expenses associated with your employee's home office, you probably can't deduct their space on like a simplified method or the actual expense method. But say you are paying them like $100 a month to have a home office space and you're helping subsidize their utilities, that's something that you can deduct as a reimbursement type expense. Or if you buy them a monitor or a chair for their office, those are business expenses to you. If they pay for them themselves, you do not get to deduct those.
Should I be paying my health insurance through my business?
I will say, go ahead, Dan.
I was going to say, good question. That's kind of a bit of a gray area. If you are an S Corp and you're an employee of the business, you have a business policy that's tied to your business, then yes, it should be paid through your business. If you're a single member LLC where it's not necessarily a policy for the business, it's like your family policy, that is still a deduction on your tax return as self-employed health insurance deduction, but it's not an expense of your business. Probably best practice to be paying that out of your personal account since it's not a business expense, just to ensure that what you're showing on your P&L is accurate for business expenses that will relate directly to your tax return.
One thing to add to that for an S Corp is if you are the shareholder, you need to make sure that that is then run through your wages. So it needs to be it needs to show up in box 1 of your wages. It increases your box 1 wages, and then there is no pre-tax deduction. So if you're paying a portion of it out of your, or you're not getting the pre-tax deduction, I guess is what I should say. So just make sure that if you are an S Corp, you have it set up to include that in box 1 wages, your health insurance.
What about for accidental transactions? Can you just reimburse the business from your personal account?
Yes. Yep.
Fantastic. This person asks, I charge AUM fees in arrears, but only bill the final Q4 bill to clients after the year end is over. If I wanted to do accrual accounting as you suggest, how do I designate that income in QuickBooks Online as the prior year?
So there's a couple ways you can do it. If you're going to be invoicing out of QuickBooks, you can just create that invoice on the last day of the quarter. I recommend having essentials and having it just generate on that last day of the quarter. If you are going to be billing in the following quarter, you can make an adjusting entry. Again, that's a pretty advanced part of QuickBooks, but you can adjust that income over from Q1 to Q4 using an adjusting entry and just say accrued revenue. That will show up as an asset account on your balance sheet, but it'll also show the income showing up in that given year Q4.
Just note, if this is done and you're filing on a cash basis, you will have to make an adjustment come tax time.
And I think we have time for one or two more. I think you touched on this a little bit, but how are you accounting for client meals?
I would just have a business meals expense account and you can put client meals there. Business meals, whether with a client or while you're traveling, that's all at a 50% deduction. So you don't technically need to have business meals split out from travel meals.
Just have substantiation on that receipt when you stamp a photo of it though. Say travel meal for XYPN conference, for example, or business meal with XYZ client to talk about their plan for the next year. Just have the substantiation on there.
And why is it so difficult to go between cash and accrual in QuickBooks Online?
Good question, Janice. That's a hard one. Mainly because QuickBooks doesn't, what's required by regulators on an accrual basis is slightly different than what QuickBooks generates on an accrual basis in the software. Accrual basis in QuickBooks is when you create an invoice, it's recognizing that revenue. The difference between that and cash basis is when you create an invoice and receive cash is when it's recorded as income in QuickBooks. That's the swap between cash and accrual in QuickBooks. What the regulators really want to see is when that revenue is earned. So if you're doing quarterly and you bill for something in advance, you didn't earn any of that income until each month is over of that quarter. So that's where we're doing manual data entry, manual data manipulation to show that revenue being recognized on that month in which it's earned. You have to show a liability account for that unearned revenue for the potential to have to pay that client back as well. So that's kind of why it's so difficult.
Yeah, and for those, it's all with an adjusting journal entry, and you can't mark the adjusting journal entry to take place on a cash or accrual basis. So as soon as you do it, that's when it's going to hit. And that's why it's always difficult if those adjusting journal entries are made.
I know that we have a few more questions, but I want to let Dan and Hayley get back to their days. So thank you all so much for being here. We would love to get your feedback on today's webinar. So we're going to drop a link in the chat to a short survey. Let us know if this was helpful for you. And of course, don't forget to register for next month's webinar. We're going to be here with the Senior Director of Member Success. And she's going to be talking about how to launch, run, and grow a successful fee-only firm. That's going to be the first Wednesday of November, the 4th. And I think last thing I want to mention is if you haven't grabbed a ticket to our virtual conference, it is next week. I've gotten a sneak peek of what's to come, and I promise it's well worth your time, especially for those folks who are just in the preparing to launch stage. We have a specific track just for you. Dan and Hayley will also be there with their FA Bean Counters team, and there'll be a full exhibit hall, a number of community events that you can dive into and virtually shake hands with everyone. So definitely highly recommend checking it out. It'll be exciting, it'll be fun, and you'll get just a taste of what's to come in terms of the community at XYPN. Dan and Hayley, thanks again for being here. Everyone have a great rest of your Wednesday, and we look forward to talking to you soon.
Thanks everyone for coming. Hopefully talk to you soon. Bye.